So a question on calendar/horizontals. Jim sent me an email this morning. He asks, I know from videos that you're not a fan of calendar spreads. Well, I like diagonals and poor man's covered call and the reverse structure for calendar puts. I don't like horizontals, is what he means. But he says, I would like to see where I can evaluate short-term calendar spreads that have high volatility differentials due to events such as earnings. For example, 2 to 3 week call at the expected move buy, and same strike sell near term within a week or so with that date after an earning or other significant event that is creating high volatility. I believe this curve flattens out more on the upside portion of a graphic display of a calendar spread. And typically you're right, but you have to account, of course, for implied volatility of crush, because the expectation of the gain or monetary value you'd still have on the long option might not be the same in those cases. All right, so let's go ahead now, and I know I just came back here for one slide, but let's navigate over to power options for Jim. Let's follow the steps where he can do what he's seeing and see if we can do any type of analysis in that case on what we would be looking at. All right, so let's go ahead now. We're just going to navigate, Jim, right over to calendar call spreads, and we're going to go right into the search tool. Now, this comes up with our default criteria, calendar leaps number 1. Not a lot of good implied volatility ratios, but again, these are looking for the default, a standard structure. We're going 30 to 50 days out for the sold call, and we're going in the money with a far out 4-month, 5-month, 6-month, or further leap option. This is sort of the poor man's, one of the two defaults. It's a poor man's covered call structure. What you want to do, Jim, the first thing you should do when you come into the search, you scroll down below the listed trades, is switch over to the default same strike spreads. This is forcing it to look at the horizontals, the same strike spreads using certain criteria. But again, you see the time frame is very similar, 40, 49 days out in time, buying calls 200 and 300 days out in time. First step is we want to switch that criteria, okay? We're going to put this at 2 to 8 days. And Jim, the reason why I'm putting it at 2 to 8 days is because if I put 0, it'll try to pull up options that just expired today because they're still in the system. So we're forcing it to go out 2 to 8 days. We know next Friday is 7 days away. That's the 1 week out for our near days expiration. Our far days to expiration, 2 to 3 weeks out. So let's go ahead and put in 15 to, let's say 25. It's a good range there. And we've got some other criteria that we may or may not need to change. We'll keep restricting it, not skewing it, I should say, Jim. We're not going more than 10% in the money with the strikes we're using or more than 10% out of the money. Leave this debit to strike difference ratio alone. This strange value of the debit to strike difference ratio of greater than 3.99, horizontal spreads by default says you can't divide by 0, the strike difference ratio of 0. We defaulted in the database to 4. So that's helping you do that, but you could also just set your strike difference equal to 0. Now we've got some other base criteria that are in here. For example, fundamentals, earnings per share growth. Okay, bullish stocks, price to earnings, 0 to 70. And we could probably take that out and not have any real effect. And what I want to do is change this right now. We're going to change it to be not between now and expiration. I want to run this first, Jim. And so what do we have? I've got a position here, 9th of September, selling a call on Williams Companies. The stock's at 33.72, selling the September 33, just a little in the money for 80 cents, and buying the 23rd of September, 21 days out, for 120. But midpoint is 25 cents. The debit would be 40 cents at natural, but at midpoint it's only 25 debit to enter the position, a potential assign of 132. Implied volatility ratio not too great, and earnings aren't expected till 10/31. It's unconfirmed, but it's probably somewhere out in that time frame, Jim. So this is the opposite of what you want. But I wanted to bring this up first. Let's take a look at the profit and loss chart of WMB. We could use BBBY or some of the other stocks as well. But this is what you see with a horizontal position. You've got the chance to lose in the upside if there's a big swing, but we're not expecting a big swing necessarily because we're not trading around earnings. The upper and lower break even, it's close to 10%, I'd say. No, it's not. I'm sorry. So it's $2 to the downside and only about 60 cents to the upside. Let me write that down. I'm sorry, $2 to the downside from our $33 stock and 60 cents or so, 62 cents to the upside. So we're only looking at a possible movement here of 2%, roughly. Yeah, 60 cents, 2% to the upside before we hit the break even. And to our downside, of course, we've got a little bit more cushion there. We got $2. So it's about 6%, roughly, before we'd hit the break even. So yeah, it's not, I wanted to show this simply because get an idea of what it is without the implied volatility increase or ratio that Jim is looking for by playing the position away from earnings. The earnings is way away from what we're doing with the shorter term trade. But that gives us a gauge maybe of what we should expect. Not a lot of movement, horizontal in this case, in this structure, with the lower volatility and the opposite implied volatility ratio we probably want. We want an implied volatility ratio of greater than 1. But not seeing what we want here, small movements one direction or the other, but we're not playing it as an earnings play, so we're not expecting small movements. Now, let's go back and let's make that change. Let's go between now and expiration, meaning that the earnings date is going to affect the implied volatility of the options, sort of based on Jim's question. Let's go ahead and submit that. And we get a few now. American Eagle, 9th of September, 11 strike at 65 cents. Natural, again, 21 days out, 23 September, 11 strike at 92. The midpoint debit is only 15 cents if you can get it. But at natural, we're looking at about 27, so it would still be pretty expensive. High percentage return. Implied volatility ratio, exactly what you want, 1.38. The short option implied volatility for the 9th is 1.008, and the IV for the long is 0.73, 138 or 1.38 implied volatility ratio. Earnings coming up on 9/7. Academy Sports, ASO, Dave & Buster's, Nio, and Billy are all here, and all of them with the implied volatility ratio you'd want, 1.3, 1.2, and along those lines, all with earnings coming out soon, 9.8, 9.7, and more. Now, let's take a look at, I'm going to use Dave & Buster's because that's closer to the one we just looked at. WMB, the Williams Company, was a $33 stock. This is 42. Percentage-wise, it should be about the same. Yeah, I'm going to use the 42 right at the money. The stock's at 42.03. So, 5 points down, 37.73. Okay, $4.30 down, break even with the current implied volatility on this position. So we're looking at 10%, right? Up to the top side, 5 points to the upper break even, 10%. Getting in at the midpoint here, this one was 65. I know AEO is at 15 cents, excuse me, there, but here it's at 65 with the 42 strikes, and you've got a 10% upper and lower break even as opposed to the 1.9 and 6% that we saw with the non-earnings position. This, I believe, is what Jim was referring to when he said that I believe this curve flattens more on the upside portion of the graphical display. In a sense, it does because it takes longer to get to that break even. But Jim, what you always have to be careful with in these scenarios is you're going to get the volatility crush on your favor for the short option once the earnings comes out one direction or the other on September 7th. Now, if it does drop 10, 15%, you might see high IV, but this thing only has 2 days to go. You're going to expect a volatility crush. Let's say the earnings come out and it's nominal. The stock moves up 2 or 3%. You're in a good profitability range. Remember, the profit you see on this chart is based on what the expected value of the options would be if the stock essentially is trading at this price, the peak price, and implied volatility remains the same. So let's say the stock does move up that 2% or so, 80 cents. Let's call it $1. Let's say it goes up to 43. Let's put it at 44. Okay, let's give it a true 5% movement after the earnings. But at the same time, We see this implied volatility drop at that point, so maybe only 0.34, 0.35. Should change that. And this one drops down. Well, okay, maybe it's not going to drop that far on this particular stock, but let's say that that one does close to expiration, and this one drops down to 0.45 from where it was at 0.7 almost after the event. See, now the profit you're expecting, if the stock's at 44, is only $18 in value. Whereas if you look at the chart here, you're expecting it to be $56. I'm sorry, at the halfway point on 9/7, right after the earnings, at $56 or $81.51 at expiration if you held it all the way to the 9th and the stock was trading at that price. But that was all based on the remaining value of the long haul still being at 0.69 delta. If it drops because the earnings come out, the earnings are favorable, the event is over, which it usually does, unless there's a big swing downwards that increases implied volatility in that case, Jim, you have to use this tool to calculate the expected. How can I know what this could drop to, the September 23rd call, what it could drop to after earnings? Well, that's why I like to go here. We'll go to our long option. I'm going to go to the research tool, option research. And what this is showing me, this option was released on August 5th. This is showing me the implied volatility of the option versus the price. I'm sorry, implied volatility is here. The implied volatility of the option over the price. But further down below, I can see the total IV range. Since this option has been released on the market, we're currently at 86% IV range for the long option. It's been from 0.53 to 0.02734. So my 0.45 might have been an over-exaggeration. Depending on the outcome of the earnings, it still might drop down to 0.45. Let's use 0.55. Let's just say it goes down to the lower range of the expected value for Dave & Buster's. And if the stock moves up that $2 or that 5% to 44, and this one still declines too, okay, that's a little bit better. And so we're 44 and 9.7, IV of 335. We get some profit on our short option. It's not fully decayed yet. It's now $2 in the money, so it's going to be at intrinsic value. But we still keep a good value here, so we're a little bit better. We're closer to that $50 that we were expecting when we hit the lower range of IV, which is going to be around 0.55. It could stay at 0.6. Now, yes, of course, if the market falls, there's a big Dave & Buster's misses earnings completely or guidance is completely thwarted, and it falls down to $37, $36. Well, you might see an increase in implied volatility, but what are you doing? You're holding 42 strike calls sold and bought that are essentially going to zero because the stock's now at 36. So yeah, we know you'd be in a loss. You know that. Okay, that the chart is telling us that too. But again, that's just what to expect. But Jim, your comment, this flattens more on the upside portion of a graphic display. Yes, when you have that higher IV, it's flattening in the sense that you have a much wider range of lower break-even to upper break-even because of the IVs in this case. But don't expect to always see the profits you're expecting on this chart or on your broker's chart, because that is solely based on the implied volatility remaining the same. Use this tool here on the profit and loss chart to analyze and estimate what the change in your potential expected profit might be if you go back to that lower range of the implied volatility for your particular option and your particular trade. Link to the research tool there. You can see it graphically, but just look at what the lower and higher range is of your current IV since your option was released on the market. And that'll give you a gauge of the worst case scenario number to put in, 0.53. We used 0.55. You see how that could have affected the expected return shown in the graph because of the value of the option would be less than expected. So, Jim, I hope that helps answer your question. Start off with that same strike spread default criteria. Change your dates, 2 to 8 days for your short term, 15 to 25 for the long term. You can make other changes here. Keep this here. And of course, you could set your strike differences to 0. I removed the price to earnings, but you didn't have to do that. You could keep that in as well as almost similar results, I think, if I left it in. And then change your fundamentals, of course, to look between now and expiration for positions we are seeing the IV ratio you want, where the short option is on the expiration week of the earnings, and the earnings is coming out prior, and the long option is 2 to 3 weeks out in time. And then you'll be able to evaluate the profit and loss chart using that implied volatility shift in the calculate feature to make sure you're determined in the right path. So for anyone, I want to emphasize this again here, for anyone who's trading calendar spreads with or without earnings, anytime, or even a married put, and you've got a call sold against you, you're in a collar, but your sold call is out to September 16th and your put's out to January. When you evaluate the profit and loss chart, especially for the calendars or double diagonals, you want to make sure that you account for what would happen to my position if there was a shift in IV for whatever reason. We're still at a very high VIX, so if the market starts going back up, as we saw with the maybe market sentiment indicator with the light buys and buys coming through now again, and volatility drops, well, that's going to change the volatility across the options as well, all across the market. Yes, the ones that have earnings are going to be different. They're still going to be enhanced and probably in their same range, increased implied volatility because of the known event coming up. However, the rest of the market might start to shift if you're just in a poor man's covered call and you want to evaluate the graph based on the implied volatility change. That is the steps you do it.